Good afternoon. This is Ken Long from Tortoise Capital with a review of the weekend trading report for April 26, 2014. We have a market that's back in bullish normal conditions. On an annual basis, using weekly RSI 14, we're slightly above the midpoint of neutral at 61 out of 100. Short-term market condition using the 10-day NDX is also at the above the midpoint in the neutral condition at 70 out of 100. So midpoint in both. Looking at the market mosaic, the long-term trend, price relative to the 200-day moving average, we're red bullish at 5.85% above the 200-day moving average, so almost 4% cushion to sideways conditions. The 5-day slope of the 50-day moving average at yellow neutral at 0.36. ADX is still weak at 14.6, so a non-trending market. Relative volatility declined back into the normal realm at 1.04%. The risk index is the 30-period moving average of the VIX divided by the 10-period. The threshold between risk on and risk off is 1.0. Current reading at 1.03 supports a risk on posture, meaning that owning riskier assets is favored. If we take that score of 1.03, compare it to the last 5,000 trading days, and then find the z-score, we compute our risk Z at 0.26. This histogram is a 90-day time series of that indicator, and you can see that the volatility has just been wobbling between 0.5 and minus 0.5 lately, with the slight hat tip to the upside. This actually looks favorable for a lack of volatility in the marketplace with rising lows. So we'll see where we're at there. Blended monthly rebalancing. Next reevaluation is on or about 1 May. The current holdings are shown here. These are the current leaders based on the most current update in the blended monthly rebalancing for each of these different trading populations. ETF 13 is looking at Australia real estate and treasuries. ETF 22 is utilities, Australia, and energy. ETF 32, agriculture, utilities, and Australia. ETF 2, the theoretical exposure remains at 70%. Model portfolios at 80%. No change. The quick look at the ETF 13 and 32 portfolios just to look for market leadership. See, there's only a handful on cash signals, which is computed by price compared to the 4-month moving average. Japan, U.S. small caps, and technology. Otherwise, everything is on a buy. Mostly healthy in the ETF 32 as well, with agriculture, utilities, the defensive plays like Australia at the top, along with real estate. It's the U.S. markets, and then China and Japan on cash. The ETF Max takes a look at the top 50 within the ETF database, the master database of about 1,300 ETFs. Coffee remains at the top, along with agriculture, softs, nickel, Egypt, India, natural gas. So it's the real properties and the energies. This is a new report I've added. This is looking at the top 50 in the S&P 500 and the sector component that they are members of. Again, we like to look at things that are green followed by white, because that tells us very strong on 3 months and a relative newcomer to the relative strength area. So we'll continue to develop this idea. I will add next week a summary of the average positions inside each of those sector spiders, and then breakouts of the top 10 holdings of each, so that we can start drilling down deeper into the market leadership inside each of these sector spiders. So, new report. Looking at the market health check. The vertical blue lines are 10 20 and 30 days worth of look back. The horizontal purple lines are price targets that have been resistance before, and you see that last time it reached this level, there's a sharp sell-off. This time it gets to 188 and starting to sharp sell-off. The horizontal red lines represent support levels that have held in the past. This rising red line here is the 200 period moving average marching its way northward. We have three regression channels, RAF regression channels here. The blue one is the short-term 10 period, sloping sharply up based off this move from 181 to 189. The black channel is the 30 period, lagged by a day. That's basically flat, this non-trending sideways choppy market that you see that has come back to the Bollinger Band mean and the midpoint of the 30 period regression line. So the market at a natural respiratory pause. And then the green channel is the longer term 90-day channel, and the outliers, the outer channel lines, are formed by the maximum excursion during the look back period. So the 90 is sloping up, the 30 is flat, and the 10 is up, but is pulled back to the Bollinger Band mean here in the middle of the river. So the dark blue shaded area is the 30 period Bollinger Band plus or minus 1. We call it the river. And the lighter blue shaded area is the floodplain plus or minus 2 standard deviations on a 30 period Bollinger Band. The red line in the middle is that midpoint, the BB mean. That's the center point of the truth about price. This pink shaded area, or light red, is the dragon. That's a 10 period Bollinger Band plus or minus a half. So that often front runs. That's going to front run changes in direction. And when we get these moves outside of the floodplain, and then the dragon comes out of the river and then reverses, those become important turning points. Here was another one. Where the dragon was riding the top edge of the river. And now the way price is looking, we would expect support to be found at the Bollinger Band mean. That's the bottom of the 10 period channel, the midpoint of the 30. And this is a market that has failed to fail. Still, it's bullish normal, so the upward bias is still in place. The slope of the 30 has been improving. This is the time series of that 30 period slope. So this is a natural place for the market to find support and resume. If it gets above 188, we are in the green zone, which for me is the place where I have an automatic long side bias on daily and swing trades. When we're in the yellow zone, I am direction neutral on the intraday trade, but I still have a long side bias because we're above the 200 and we had found measured support here at 182. And the last impulse was up. If we were to get below 182, then I would have a short side bias on the intraday trade. Looking at Williams percent R, we've been oversold for a couple days and have pulled back into more of a normal condition. The jaws of percent price oscillator are open to the upside, so that favors the long side move. So I have a slightly upward bias here because of the bull and because we've pulled back in an orderly fashion to the Bollinger Band mean. ETF2 regional report, 7 out of the 10 regions are on buy signals, so that keeps us at 70% invested, 30% cash in the theoretical model. The S&P at 42 is slightly better than the globals at 40. So the U.S. is favored over the globals, although Europe is, IEV is tied now with the S&P. Inside the U.S., it's the large caps, mid caps, then tech, then small caps. The two strongest sectors are Asia less Japan and Latin America. Haven't been able to say that for a while, although for the last about 3 weeks that's been the case. The two weakest sectors, U.S. small caps and Japan. Sector spiders in the U.S., energy and utilities. The defensive plays are dominating. And weakness in technology and consumer discretionary, which had been the early leaders during the first part of this year. So the truth has rotated. Looking at the world market model globally here, half the U.S. is above average, half below, favoring the Dow right now. In white is above average. Dow and the S&P, whereas the small caps are showing the weakness right now. Japan extremely below average. Asia less Japan looking pretty good. Strength in Australia, India, Indonesia. Um, inside the European region, the large caps are doing well. Weakness in Sweden, Germany, Netherlands, Austria, Belgium, and Switzerland doing well. Inside the global business sectors versus the U.S. business sector, slight hat tip to the U.S. With the strength in energy and utilities being seen in the global counterparts as well. Top 30 ETFs based on the ETF2 model remains agriculture, Indonesia, India. Um, the utility sector has now moved up into green and white conditions. It doesn't happen all that often. That's just a sign of concern and a defensive play. Some new emerging strength here in energy, S&P, international commodities. Turkey remains an interesting play. Australia and oil services, both extremely liquid, both doing very well. Um, that should be on your short list. The Dow 30, new leader Johnson & Johnson moving its way up to the top, green and then white. With Caterpillar, Merck, DuPont at the top. In the red, we have Visa, Goldman Sachs, Boeing, and Verizon. So new failures are really Verizon and Visa because they're red on strength and yellow on consistency. So that's continuing to fail and joining our former bottom feeders, Boeing and Goldman. ETF liquidity, just for your reference. Shifting now to the daily report for Monday. We have channeling and overreaction signals in emerging markets. AT&T and Intel also joining an overreaction channeling with Intel on a triple screen along with ILF. That ought to be very interesting because that's been the strongest region. So if we get any kind of bump, be taking a look at ILF and EWZ Brazil to continue their relative strength leadership. In the auto framer, it's AT&T, IBM, Verizon, the VIX, oil, gold, emerging markets, and Cliffs Natural Resources. Looking at the Dow 30 tactical summary, we got a half a dozen that are signaling on the RSI2. So we should be looking at IBM, AT&T, and Verizon. They are all in the single digits in RSI2. They're the top three in max pain range compression. They're all at least 4-to-1 or better on the auto framer. And AT&T is also a 551W and a channeling and overreaction signal. So that should be on our short list for framing. In the ETF 30, 4 on an RSI2 signal, emerging markets should be of interest. It's number 2 on max pain range compression. It's a 3-to-1 on the auto framer. It's a channeling and an overreaction and ended on Friday in a doji. And with the strength that we've seen creeping back into emerging markets, that should be on our interest list as well. Autoframe Stats for you. And the market mosaic. You can see we've pulled right back to the 30-period regression channel, but the polynomial is still showing up. If it gets above 189, that's all-time high, and we should pile on at that point. The S&P stretch is showing the weakness of this bull. It's had 2 sharp sell-offs and a set of declining highs, so that's a sign of an aging bull here. On the other hand, we've just completed a 2 sigma adverse, almost a 3 sigma adverse move in regression line slope, and it has now crossed its own 10-period moving average and is hovering right at the 6-month baseline. So this is a natural place for it to go up as in a resumption of the bullish trend. There's been dithering in the Crimea, and that is still in tension, but it has not dominated the news. So maybe we've processed all the worry and fear and are now positioned to resume northward travel. And that's everything I want to cover for this weekend report. More of the webinar, and I'll see you in the chat room. And keep your powder dry and your wrists measured.